Hello, this is a tutorial to show you how to use a Forex calculator to calculate the correct amount to risk for your account size so that you do not risk more than what is healthy for your account, so you don't lose more money than you should lose if you ever maybe you issue a trade and the trade is going to end up a losing trade. You should not have lost more than 2% of your account. The goal of risk management is to make sure that you risk less to make way more. You should risk less to make way more. You should not be risking more to make less. It's not a good way to trade. So you go to Google Play Store. If you're using an Android phone, you go to Google Play Store, you type Forex Calculator. Several options will come up, but the best one that I've used so far is the third option, Forex Calculator. I have it installed already, and this is what the icon looks like. This is what the icon looks like. Okay, so since I have it installed, it's here, the third row, the last app on the third row, Forex Calculators. When I open it, this is what you're going to see on the home page. The position size is the default setting on the home page, and actually that's what you need because that's the major thing you will be using. Let me turn off my data. Okay, so now before you start calculating how much to risk with this particular app, you need to go to your settings and make sure some things are in place. Now your account currency, I assume that your account currency is in US dollars because that's the common account currency. Then you also want to make sure that you selected the position size as standard loss. Everything will be calculated based on a standard loss calculation just to make things easy. Your account leverage, depending on what leverage you use, it will usually run anywhere from between 1:200 to 1:500. If you don't understand what leverage is, please go and get some foundational knowledge on babypips.com. Okay, so for my account, I'm using 1:500, and so you shouldn't go more than that because leverage is like a loan that you're borrowing from your broker to trade with. It's almost like your broker is boosting your account size for you, and if you use too much leverage, you end up losing a trade. You would have lost more money in your account. So you should use leverage very carefully. Some very conservative traders will use nothing more than 1:200, but the worst you should ever go is 1:500. That means that for every dollar that you have in your account, your broker is loaning you $500, so you can make money as if you had, $500 in your account for every $1 that you have there. That's how leverage works. So it's a two-edged sword. If the trade goes in your favor, you make a lot of money. If it goes against you, you can lose a considerable amount of money. So use leverage very carefully. So 1:500. All right, so those are the two things you need to keep in place. So once you have done that, then you come back to this home page, and then you enter your account size here. Let's say for me, I really wouldn't, it's personal, but I don't see any reason why somebody should be trading with anything less than $500. If your goal is to actually especially if you're following a signal service, if you're trading by yourself, it's a different case. But if you're following a signal service or something, I honestly can't see how you're going to make meaningful profit without a lot of unnecessary headache trading with less than $500. That is the barest minimum I think anybody should go. So but let's assume that my trading account is $1,000. Okay, now I should also expect that you have calculated the amount of the stop loss in the amount of pips in your stop loss. So I would expect that you've calculated the number of pips in between the entry price and your stop loss. If you are not familiar with the concept of pips, then it means that you need to go and get the foundational knowledge that you need in order to be able to do that. But I'll just do a quick example here. So this is a particular trade signal from someone. Let's look at this GBP CHF trade signal. and the entry price, the recommended entry price to enter the trade was at 1.1960. Now, this is a currency pair that uses a 4 decimal places, configuration. So unlike the GBP, JPYs, and the JPY pairs that use 2 decimal places. So now, for this particular one, the stop loss is at 1.19125 and the entry price. So I am going to, and this is a buy trade, which means that the stop loss is lower than the entry price. So I am going to open my calculator here. Now 1.19600 minus 1. Let's see what the other figure is. Minus 1.9125. 1.9. Sorry. Okay, 1.1925. 1.19125. Okay, so the resulting figure is 0.00475, and we know that for 4 digits, for currency pairs that use 4 decimal places, you start counting from the 4th decimal place, which means that the number of pips in the stop loss, that's the difference between the entry price of this trade and the stop loss level, is 47 pips. That's 47 pips. So if I had a $1,000 account and I entered 47 pips here, and I'm risking 2%. Now, what this means is that the lot size I will be using if I want to issue a trade, if I want to enter this particular trade on a $1,000 account, if I want to enter this particular trade with a 2% risk on a $1,000 account, I will be using the lot size of 0.04. Always look at the standard lots. Forget about every other figure you're seeing there. Always look at the standard lots on the 0.04. So if I'm going to open a trade, this is what I'm going to use as my lot size. Let me give you an example there. Okay, let me just use a random example here. Oh, what's wrong with my network? Okay, so let's just say I want to issue a trade on this particular currency pair. Is there anything wrong with my network? Okay, let's look at this. Open chart. Okay, let's say I want to issue a trade on this. I will make sure that I come to this particular part where you enter this 0.01. I'm going to reduce it to 0.04, and then I'll click. This is just a random example, like you can see, and then I'll click buy or sell, and that's how. And this is a demo account. This is not a real account, and then that's how you do that. Okay, so that's how you calculate your stop loss, so you don't. So that means that for this particular trade, if I want to enter this trade, I will be risking just 20%. I'm sorry, $20 out of $1,000, which is exactly 2%. To make how many pips? Let me see. If we calculate the distance between the entry price and the second take profit, second TP, let's see. Let's calculate. 1.21725. It's a buy trade, so that means that the destination price is higher than the current price. 1.21725 minus 1.19600. Right? Okay. So from the take profit, second take profit level, to the entry price where we enter the trade, this is a 212. This is a 212 pips trade. This is a really good trade. So it means we're risking 47 pips from the stop loss to make 212 pips. That is 1:5. An ideal trade, the risk to reward ratio for an ideal trade should be 1:3 minimum. Ideal minimum is 1:2. is the minimum. Ideal is 1:3. The best are 1:5 and above, and this is a very, very good trade. Okay, so that's how you calculate your risk per trade. Now the recommendation is that if you are taking a series of trades together on different pairs, you should not risk more than 8% in total. 8% risk. That means that if you're risking 2% per trade, you can only take 4 trades at once across different pairs. Let's say your signal provider provided you with maybe like 5 trades in the day. You can only take 4 trades. Now, this tutorial does not cover other financial instruments that are not Forex pairs, or there are not spot metals like gold and the rest of them. When we're dealing with indices, I think we're going to have to take a manual approach to calculating that. Might have to do another tutorial on that later on. All right, so that's that. Thank you.